welcome to tonight's class. This is the first class that we're going to be having on a weekly basis for new members, new signups here. Those of you that are new to options need to understand what we're doing. Okay, so tonight, first off, guys, let's go over the charts, SMAs, MACDs. How do we set things up here? I just went over a member that's totally new to trading here that I said, hey, join us on tonight's class here. This is going to be a perfect class for you. So first off, guys, look at the chart to the left and to the right. Okay, so to the right here, you can see we have a lot more. Details on the charts, the candles with the SMAs and everything going on here. Over here, this is a simple line chart. So when you're opening up a brokerage firm, first off, they're probably going to start you with the line chart or the mountain chart or the hollow candle, colored bar. So this is telling you where we open, where we went up to, down to, and where we close the day at. That's what these bar charts are here, these colored bars. And then obviously if it's red, it opened here, got up, down, and then closed here at that little indentation. But what I want you guys to focus in on here is not candle, because the candle it's going to be colored in and it's not going to give you as much information as the hollow candle. So I want you to choose hollow candle, and this is what we use. So now you see when we got that hollow candle there, things are looking a little bit better than a line and things like that, right? So now what I want you to do is go up to your studies, and we're going to add our moving averages. These are going to help us a lot. So first one we're going to do is the 50. That's the standard one that comes up. I always use the 50-day simple moving average as the red one. So there's the red 50 SMA now. Okay, now the reason why I like the 50 SMA is because this is more of an industrial support area. So when you have the bigger institutions and the hedge funds selling, usually you'll see a retracement down to that 50 SMA. And that's why it's important for me to keep that on there. That way I could get a little bit more inside information as to if we're seeing some retail traders selling off here, pulling back down to that 10-20 simple moving average, or are we seeing some serious selling pressure like institutions selling hundreds of millions of shares that we're seeing this volume in and these larger candles that are bringing us back down to that 50 simple moving average. So that's one of them. Second one here I want to add is the 10. And the 10 I like to use as yellow because that's the one that's going to signify our breakout momentum. Okay, so now we got the 10 and the 50 SMA, and all these are each day the previous 10 candles average. Okay, so if their average is like, let's say 10, 5, 10, 5, 10, 5, then the average is going to be 7.5 on this day, and that's right where that average line will be for the 10-day simple moving average. Okay, so now what we also want to add here is the 20-day. This is going to be more for our breakout momentum because when I cover my private classes with our members, they say, well, why do you use each of those candles and what do they represent? Well, that's a good question. And that represents either A, breakout momentum, because first candle below that 10 is sign of a retracement there. We're going to be going over that in a little bit here, but it's really important for the 10, 20, and 50. Now, if you're a little bit longer term of a trader, the 200-day simple moving average is a great line you guys could be putting on there, and that's just going up, and you can put 200 SMA, and usually I use the pinkish line for that. And you'll see if you come down to that, if you're really dropping below that 200-day SMA, you're looking for some serious selling pressure. But I like using that 50 because once we drop below that, that signifies usually a cycle change and breakdown momentum there. So that pink one is more institutional, and that's for much longer term trading. So we don't need that one there, so I'll delete that one. Right now, what's important is that yellow 10-day, blue 20-day, and the red 50-day simple moving average. So now that we got our candles, our hollow candles on here, we got our simple moving averages. Next, we need something because with our trade plan, we have 3 check marks for confirmed entry or confirmed exit. So 3 check marks for confirmed entry. Okay, now one of those candles that we're going to be using here, one of those indicators, we're going to be going down here and we're going to be using MACD. This is the moving average convergence divergence. First thing I want you to do is keep it at its normal setting. 12, 26, 9, that's the standard one. You can keep it at that. There's no reason to change that. So what we're looking for are these lines crossing each other. These are going to give us confirmation with our trade plan. Okay, so now that we have the MACD, the SMAs, and everything pulled up there, but right now you're looking for that 1020 cross, the MACD cross, and then that first green candle above that 1020 SMA there. So those are your 3 check marks there that we have for a confirmed entry. We have 3 check marks. One of them is going to be the MACD cross and above for calls, below for puts here. And then obviously the 10 crossing above the 20 showing signs of momentum, because obviously if the candle's higher the past previous days than 20, that's showing a shift in momentum there. Okay, so that's important, that 1020 cross, and then that first green candle after that 1020 cross. Okay, so when I'm talking about here's a good setup here, we got our check marks or confirmed entries, that's what I'm talking about. I'm saying, okay, we got our MACD confirmed, we got our SMAs confirmed, and we got our candles that are confirmed in breakout momentum. Okay, so that's really important there that I want you guys to understand that. Now, obviously, there's some people in here that are totally new that have never traded options before. So I want to go over quickly calls, puts, when we're using them, and why. All right, so obviously you could see here that there's different cycles we take advantage of at Breaking Chart Alerts, okay? You could see the red, you could see the yellow. I mean, I do this for years, so I could probably go back quite some time and you'll see all the channels here, right? This gives us a signal of what stage and what cycle we're in. So we have cycles and phases. So our cycle, our first cycle, 1020 cross, MACD cross, that's shifting from breakdown momentum to breakout momentum. So the green channels here are the breakout momentum. The yellow channels are areas of consolidation or NTZ, no trade zone. Okay, and that's really important here because our trade plan is going to signify where we're entering, when we're exiting, and our price targets and our support areas and our stop areas that we're looking for. So I love using these channels as a guidance here. If you see green, obviously this is when we want to start buying calls and start either buying calls, spreads, or we could be buying shares of stock. When we're in yellow, that's no trade zone. This is a time for day trading, usually increased volatility, and that's going to be a great time for doing some day trades here. And then once we turn red into the red cycle here, breakdown momentum, as you can see here with COVID, you know, we usually have a nice breakdown. We got the 1020 cross and below, and then here's the first red candle below that 1020 cross, and then here is the MACD cross here. So we had 1 check mark here, 2 check marks, and then the third check mark is that red candle that's trading below that 10, 20, and 50 simple moving average. So right here would be our entry for some puts or shorting shares. Okay, that red candle right here. Why? Well, here's that 1020 cross. Here's that first red candle below that 1020, and then we have the white line crossing below the red here, signifying the MACD reversal, and now we have our 3 checks. So this is the area where we want to buy puts or short shares of stock. And it's really important because when we're in breakdown momentum, now here comes the reason to why we're using that 10, 20, and 50 simple moving average. So when we're dropping down, I always like using that 10-day simple moving average as our resistance area. And as you can see here, when we're using that as a resistance area, you can see how the candles are getting up to that 10, and then it's failing, and then we're heading lower, and we're having that next breakdown again, right? And then we're getting that little bit of a climb, and then we're having that next breakdown. And then you can see here, this is from about, so this is about February, I don't know what this was, 22nd or something, but this is the end of February. And then we continued to break lower until we got that first candle above that yellow 10-day simple moving average. And once that happens, this is the area of NTZ or consolidation. When you're trading between the 10 and 20 simple moving average, this is NTZ, or this is also considered consolidation. Okay, so when we're trading between these areas here on breakdown momentum, that's not when we want to be trading. As a trader, we're being patient, we're being disciplined, and we're really looking forward to these breakdowns here that we could take advantage of during this whole cycle here. So those are the kind of moves that we want to take advantage of. This is what I call a breakdown momentum. So BDM, when I show that on the chart there, that means breakdown momentum. So that's obviously where we want to be buying puts. Now, puts are going to make us money as the stock drops lower. calls make us money as the stock climbs higher. So when we're in the green channel here, that's when we're buying the calls. That's when we're buying the vertical call spreads. When we're in the red cycle here, that's when we're buying the puts or the vertical put spreads. It's really important. So we're going to make money regardless whether the market drops or whether it climbs here. We have different strategies and techniques that we can use here. So obviously we're going to be doing the puts when we're heading lower, the calls when we're heading higher. Okay, now what's important is what we're doing in the middle of these cycles here. Okay, and that's why we're using, I'm talking about the 10, 20, and 50 simple moving averages here. Because if we're using those 10, 20, and 50 simple moving averages that you see right here, this is going to tell us how strong of a breakdown or breakout we're having. Because if you look and you see that first 2 times here that you're getting up to that 10, that yellow 10-day simple moving average and failing, that's showing real signs of strength in that breakdown momentum. And that's when you want to be a little bit more aggressive with our trades here as we get up to that 10 and then that first candle with the body below the previous candle's body right here. So let me try to zoom in here. And I want to share with you guys exactly what we're looking for in the middle of the cycles here. So in the middle of the cycle, when we're breaking down and we have that first couple of days of breakdown, this is usually when we're first getting our hedges on, okay? Because if we're in breakdown momentum or if we're in breakout momentum climbing and then we get that first big candle below that 10, 20, 50 SMA, we're saying, hey guys, this is the first time in the whole breakout momentum cycle here previously that we have a candle below that red 50-day simple moving average. Something's up, something's going on. Right here on February 24th, you see that long wick, and then you see the body of the candle here that's well below that 10, 20, and 50 simple moving average. Obviously, this is coronavirus that happened, and that's why we had that pullback. But you need to be able to identify these cycles here because that's really important as a trader because they happen all the time. All the time here. You could see exactly what they do and how you could take advantage of them. Here, you're having a breakout momentum, retracement down to about that 20, breakout momentum, holding that 10 on that breakout, continued climb, coming down to the 20 and breaking higher. You know, so these 10, 20, and 50 SMAs are really going to help us decide where we're coming down to that next support area. So looking back at this, when we saw that we had from October until February of breakout momentum, not a single candle or body below that red 50 SMA, that's a breakout momentum, you know, and that's saying, hey, we got a strong breakout here. Now, when you saw this first candle here with that body below that 50, that's telling you, A, you better watch out those long calls. If you have long calls right here and you're shifting into a new cycle, that's when we're going to be adding into those puts. Okay, that's when we're going to be protecting ourselves with some short-term puts as a hedge trade, okay, to protect those longs if we have. And then once we break below that support at 320 there, that's when you're telling yourself, okay, now you got to exit those longs. We're in breakdown momentum, and we're going to be heading lower. So now what you're doing there is you're shifting from one cycle to a new cycle, and that's the most important part of a stage. And that's why today when we're talking about Qs coming down to that 50-day simple moving average, it held that 270 right here. So if you could see over to the right, Qs are holding that 270, and it's holding it really well. Had a nice climb today. It was up about 3% of the highs today. We pulled back a little bit since the closing bell, but we had a big candle today. Now, what's important here is if we have a candle below that 50 here, we're going to be looking at a cycle changing. And the nice thing about it is we could take advantage of that cycle changing, you know, close to the tops there. So we had a nice breakout. Now, here's what we're looking for tomorrow. So this is really important because if we get a climb above that 20, we're going to have that support that was held at that 50, and then we could look for that continued climb up to that next resistance. We're going to have that next resistance right around 295 here, and then the second is going to be at 300, and the third will be at 305. But what's important for us here is, are we going to be buying some puts tomorrow or calls? And the market's going to tell us that tomorrow. Because if we get that climb above that 280 resistance and above that, you know, let's say 283 resistance here on that blue 20 SMA, then we're going to be looking for a confirmed breakout off of support. We have support at 270. So if we get a red candle below that 270 support, number one, 270, it held at that 50 SMA, right? That's really important. You see when we're in breakout momentum back here, how it comes down to that 50 and it holds it and then it continues that climb? Well, right now we're at that critical stage where we're watching to see if it's going to break below that 270 support and head lower, because we didn't get that 10 crossing below that 20 yet, did we? So that's one of our signs, one of our signals. We already had the MACD cross, right? The MACD already crossed below. So there's one signal right there. You remember how we said we had 3 check marks? Well, here's one check mark right here. You know, the second check mark would be that 10 crossing below that 20. So if this continues lower here and then we see this happen, if we see that happen, then this right here is going to be our second confirmation. That'll be our second check mark. So we have one check mark from the MACD, we would have 2 check marks there, and then that first red candle after that 1020, that would be our third check mark for a 3 checks, and that would equal put entry or shorting the shares. So that's why it's so critical to see what we're doing right now, because we're in territory we haven't been in quite some time here. So this is really important to see what we're doing here with Qs and to seeing if we're going to break below that support area and continue to have. So what we're looking for now, Qs, again, you're coming down to support. We're holding support at 270. So if we get a green candle above that 280 and above that 283 there, that's when we're going to be adding, okay? Now, we have a lot of vertical spreads. So now let's go over vertical spreads. We just went over when we're taking advantage of calls, when we're taking advantage of puts. You know, we could go over the trade plan here. When we're having that first 10-20 cross right up here, like back here, you know, you have that 10-20 cross, right? Your first green candle above that 10-20, and then you have that breakout momentum, right? Now, that first candle below that 20 is going to be your stop out of those calls. When you get that new cycle forming, that's a great opportunity to buy some calls for 6+ months out, and then you sell it first candle below that 20. And you can see here, if you're entering, you know, on the 21st of October, you're in this trade until December 3rd there, you're making a quick 100 and some % return on that move right there. And then you could be entering back in when you get that confirmed bounce off that support area. Okay, so that's really important. The trade plan is going to tell us exactly what we're doing when we're buying and when we're selling. Okay. Now, what we have to do is be disciplined traders and say, okay, when are we going to add to our longs, or when are we going to be shorting the market and going from long calls to short puts here and buying some puts? Okay. And right now we're at that critical stage. We have the election coming up, which if we do get a sell-off, I mean, you guys saw what we did during COVID-19 here. We had our best trading we ever had during that breakdown. We literally had members that made 1,000% returns or more there during that big breakdown momentum there from COVID. And we were able to call that with our trade plan. So now what's really important is saying, hey, are we going to be bouncing off the support area and continuing that climb higher? Or are we changing cycles here like I just went over? Okay, now what are we going to do with our spreads? Okay, this is a great opportunity to go over spreads, because this is when you can make a lot of money trading spreads here. Okay, so there was a reason why I went out with the October 16th Expo with most of our spreads. Number one, I knew the election was coming up. I knew we were pretty frothy here going into tech and the rest of the market. We just had to skim that froth off there on the Qs here. So we had a big industrial pullback. Institutions sold. That was SoftBank, actually. SoftBank came out and admitted they were selling a lot of tech there, and that caused a little bit of panic. So now we have to see what's going to happen with the election. Obviously, November is the election time. So if there's some fear in the markets and we continue to see selling pressure going into the election, that's something we can take advantage of with some puts and shorting the market there. But for right now, we have our protective hedge, which is great with the SPY put. And now what we're looking for is either A, that retracement below 270 so we could exit our longs and add to our puts, or B, like I said here, if we start to climb and we have those spreads, what we could do is, let me show you a picture of one of our spreads here on Facebook. To be honest with you here, this is a nice setup. So let's take a look at this September 18th. We just closed out a paycheck trade on Workhorse today, okay? That Workhorse was a vertical spread. So here is another vertical spread. This is called a vertical spread here. a vertical call spread, to be a little bit more specific. So all this is we bought Facebook. So listen out here. This is very simple and very basic. When we trade spreads, all we're doing is buying a stock for one price. In this example here, we're buying shares of Facebook at 285, and then we're selling someone. You see that minus 10 contracts. We're selling someone the right to our shares that we bought for 285. We're selling them the right to those shares at 287.50. So the max you can make on a spread is the difference between those two strikes. So from 285 to 287.50, that's $2.50, right? Now, here is what we paid for it. Our average price is right here. So 1169 minus 1039, 11.69 minus 10.39, that's $1.30. So we paid $1.30 for this to be worth $2.50. Now, there's 100 shares in a contract. So you always have to multiply these by 100. So it's going to cost you $130 for that contract we paid. The max it could be worth is $250 for one single contract. So when you see me buying, usually I like to buy in lots of 10 or 25. If you see me buy 10 contracts, that means I just spent $1,300 on that to be worth $2,500. That's a max net gain there of $1,200. Or if we divide that out, 2.5, divide that by 1.3, that's a max net gain there of 92.31%. Now that's the max that you can make on this trade as long as Facebook is at or above that 287.50. Okay, so as long as Facebook's above 287.50, this trade will make a 92.31% return. The max loss is going to be if the stock is below that 285. But we would not let it go there, because if we paid $1.30 for it, our max stop loss is half of that, so 0.65. That's going to be your max stop loss, 65 cents. So you're only losing $65 at a 50% max net loss on that vertical spread. Now, here's the thing I want to go over with you guys, and this is another really important point here. Okay, so on this vertical spread, what we could do now is the following. Okay, and this is how you really maximize your profits utilizing that vertical spread. So our max net gain on this was 92%, right? But here's the thing. Do you see how we have a $7,534.61 profit on this leg right now? This is our P and L on this trade right now. So on this vertical spread, we sold it to someone for $10.39, $1,000 for a contract there, right? But guess what? It's now worth only about $2.80, $2.90, somewhere between $2.70 and $3. That's the bid and the ask. So we could get anywhere from $2.70 to $3 for it now. So if we sold it to them for, let's just say $10, and we buy it back for $3, we netted a $7 profit, right? So that's what you're doing here when you're coming down and seeing that retracement down to support. If you got enough time, this is for the September 18th expo, right? So if this was October 16th, I'd be buying back the Facebook shorts today, you know, but since it's September 18th, next week's expo, I want to get that confirmed breakout here off of that support at 270. So now what's going to happen, if we get that green candle tomorrow above that blue 20 SMA, I could buy back this short leg here, the one that we're minus 10 contracts in. Remember, this whole trade right here is called a vertical spread. But if we buy back this short leg, then we're just left with a regular call, right? So we could buy back this short leg. It'll cost us about $2,850 to buy it back right now. This originally was over a $10,000 premium we collected. So we could lock in that $7,534 gain right now by buying back that short leg. And now if Qs continue to climb there and Facebook continues to climb, then at Expo, let's say Facebook's at 2, let's say it's back at 300 at Expo. Well, that means that 285 strike call is going to be worth at least $15, right? If it's only worth between 325 and 365 now, well, if we buy back that short leg here for $3, right, and we lock in that $7,500 profit on that short leg, well, right now you could see that we have a loss on the long leg of $8,245, right? So if we lock in that profit on that short leg, and now Facebook continues to climb and gets to 300, those 285s are now worth 15. 10 contracts, that means $15,000. So 15,000 minus that 3,450, that's about an $11,000 gain there that we're going to be having. So we could lock in $11,000 on that long call if we get back up to 300, and if we bought back that short leg right now. So that's about an $18,000 profit off of a small, what was it, a $1,300 trade. So that's what's really important about looking and viewing and seeing where we're going. Because let's take a look at the Facebook chart now. If you take a look at Facebook chart, number one, we got some serious support at 270 that we were talking about earlier today. So this is what's important about watching this. We have support at 270, okay? Now, if Facebook climbs above 280 tomorrow, that's going to tell us two things. Number one, we climbed above that 20, and number two, we held that 270 support. The thing I don't like about Facebook is how this candle is colored in. Remember how I talked about candles over here? We have hollow candles, but if you have just candles here, these candles tell you all the same darn thing, don't they? They're all colored in, right? They're all colored in. It doesn't tell you much. But here, when we're using hollow candles to the right, like you see on Facebook, what this tells us, the hollow candle tells us that it opened here and closed higher. That's why it's hollow. It opened lower, it closed higher. Now, if it's filled in, that means it opened higher and closed lower, but it's still green because it's above the previous day's close here. So that dark filled in green candle, that's usually something bearish. So that's why we didn't do anything with the Facebook vertical spread today. I want to make sure that we're getting a climb and make sure that we're holding and climb above that 280 resistance here. If we could climb above that 280 resistance and have a nice breakout tomorrow, that's when I'm going to be buying back a short leg and adding to my long calls and averaging down on that price. Now, I wish we had the October Expo, but we have September 18th. We still got about 9 days to go for that. And you see how quickly we sold off here, and you see how quickly we could really gain back that momentum as well here. So it's really important to watch now. That's what's really important. Okay, so I like to do those vertical spreads as paycheck trades on certain times, like Workhorse, for example, WKHS. Okay, we had a consolidation area here of Workhorse for quite some time. And you guys remember the consolidation area. That's as that yellow area that I showed on the charts, that we have the green, yellow, and red channels. So here's that breakout momentum that'd be green. And then we got some serious consolidation right here. Or NTZ, no trade zone. That's what we like to call it at Breaking Chart Alerts. So when you're between that 10-20 SMA and you're just trading sideways, obviously what you could see here are the candles are trading side by side. When the candles are trading side by side, that's telling us a few things. Number one, there's not much volatility coming in. Number two, this is areas of indecision. You know, we're not getting a breakout like we saw back here. You see how this breakout is totally different than what we've been seeing right here. Totally different than that yellow area. So that's why we're able to use our system and our trade plan to identify areas of breakout, areas of consolidation, and areas of breakdown momentum. And now Workhorse, we picked up when we had the 10-20 cross, we picked that up right over here when we finally broke above that. This was our entry on Workhorse. And guess what? We only paid 40 cents a contract for this trade here. We got a vertical spread. And this is the trade that we got. Let me bring it up. We had the 19-20 vertical spread on Workhorse, right? So right here was the trade we got on Workhorse, okay? We got this trade back on this date right here when we broke out. So right at about September 2nd, September 1st, whatever that candle is right there, that's when we entered. Why did we enter that? Because we had our first candle that broke above that consolidation area. We had that 1020 cross that was right here. We had the MACD cross, and then we had our first candle that was above that 1020 SMA. That's a time when you're changing from breakout momentum to consolidation to breakout momentum. When you have that first 1020 cross, MACD cross, and that first green candle above that consolidation or no trade area, that's a nice time to either A, get some calls for 6 months out, or B, if we want to take advantage of some short-term trades there, we could do an in-the-money vertical spread. And so what we did that day is we picked up the 19-20 vertical spread. All that means is we bought it for 19. We sold someone the right to buy it off of us for 20. We paid 40 cents a contract for that. Obviously, the stock was much cheaper. It's at $24.40 now. But the max it could be worth then is the difference between the two strikes. So from 19 to 20, that means that could be worth $1. So the max that could be worth is $1. We paid 40 cents for it. So if it could be worth 40 cents and it could, or we paid 40 cents, it could be worth $1. One, divide that by 0.4. That's a max net gain of 150%. That's 150% max net gain. And we got that when the stock was right at $20. So we were able to get that trade, and the stock could have dropped 60 cents and we still would have made money on that trade. It could have stayed where it's at, we still would have made money, and it could have climbed, we would have made money. We closed that trade out today for 80 cents a contract, and we closed out a 100% gain on that trade. And that was a paycheck vertical trade. So that was a vertical call spread we made on Workhorse. Was it last week? Maybe the week before? I think it was last week. Early last week we made that trade. You know, we made that early last week, and we made that a paycheck trade because we just had that 1020 cross, the MACD cross, and the first candle above that 1020 SMA after that crossover. So that gave us a really nice entry. Then the stock continued to break out, and we locked in 100% gain in less than a week on that Workhorse trade. So that's why vertical spreads are so important there, because you need a minimal move to make huge gains. I mean, look at that, 150% gain there, and you really didn't even need the stock to do anything. So that's the importance of trading those vertical spreads. Now, why am I talking about vertical spreads now? Is because, A, if we take a look now at SPY here, let's take a look at SPY. Let me change this back to hollow candle. Now, if we change this over here to SPY, and we take a look here, you could see, if we hold this area of support at 333, 335, and we get that break above that 343, then we're starting to climb there. And we could do something like an in-the-money vertical spread, and we could look at something like this. So let's take a look at our option chain here, and let's pull up SPY. Now, perfect example here is if we wanted to buy a SPY trade that has low risk, very low risk and high reward, we could be looking at that, let's say September 18th Expo, right? So that's next Friday's Expo. We could be looking at a vertical spread because I love vertical spreads when you have that. Now, if you want a safe, low risk trade setup, we could do this, buy to open, sell to open. So when you type in buy to open, that means you're saying, okay, I'm willing to buy it at a certain price. I'm willing to buy this call at, let's see, what do we want to do? We'll do 334, 335. So you're saying, I'm willing to buy this stock at 334. This is what it costs per contract now. And again, you see it up here. It controls 100 shares per contract. So if it's $10, you have to multiply that by 100. So it's going to cost you $1,000 to control one contract of that SPY call, right? Now, to reduce that cost, what we're doing is creating a vertical spread here. So now we're saying, hey, we own SPY at 334. Who wants to buy it at us? Who wants to buy it from us at 345? And then you'll see what comes up there. September 18th, sell to open. Oh, that's 345. I was looking, I'm like, what? That looks way off there. So there we go. That's more like it. So now we're saying, hey, we own the stock at 334. Does someone want to buy it off us for 335 on September 18th? And this is what they're willing to pay us for it. And they're paying us this amount here. So when we're making a trade here, we do a net debit because we're paying money for this trade. Okay, so right now you could actually pick up this vertical spread here for 72 cents a contract. What's the max this trade could be worth? The difference between 334 and 335. So let me get up the annotation here. That difference is $1. Okay, so if we're paying 72 cents for it to be worth $1, that's a 28 cent gain or $28 gain per contract. Divide that by 0.72, that's a 39% return. And guess what? Guess what the beauty of this is? Number one, we have support right at about 335. So that's our support area there on SPY. So this is the beauty of trading vertical spreads here. Okay? So if we're doing this trade here, we have support at 335. We make max gains as long as the stock's above 335. Where's the stock at right now? It's at 339.46. That means this stock could drop by $4 and we're still going to make a 39% return. Now, 39% return, that's honestly not much. You know, we have calls, we have our workhorse paycheck trade that made 100% return. But when you're trading this here off that breakout, this is a nice opportunity to buy this. And then if you get that continued breakout and you break above that 345, then you could buy back that short leg to uncap your gains. Because right now your max gains are $1, the difference between those strikes. But if you see that continued breakout momentum, you could buy back that short leg and let that long call run back up to that target resistance of 355 there. So that's what's really important about getting in early off these support areas when you're trading either calls, puts, or vertical spreads. So you're able to capture this gain there of 39%. The stock could drop down to 335. It could stay where it's at. It could climb, and you're still going to make that 40% return. So that's why it's so important for us as traders to be utilizing different strategies at different times of the market here. And right now, when we're seeing this pullback on SPY here, we came down to that 335 support. We're not out of the clear yet. You know, we have one big thing that's really going on in the market that could cause us to either head higher or lower, which obviously, you know, we're looking at probably heading lower here. But if you take a look, we have the election coming up November. Okay, now historically, the market usually pulls back end of August, early September during the election year of the presidency. So that's really important there because we have an opportunity here to either A, watch the market continue to climb, and tomorrow if we get that climb above that 343, we could be buying back those short leg in our vertical spreads, or we could either A, do that, or B, we could buy some regular calls here and look for that climb up to that 350. But that's only if we break above that 20. Because notice when we're in breakdown momentum here, let me zoom out a little bit more. When we're in breakout momentum or breakdown momentum, you see we're getting up to that 10 and failing, up to that 10 and failing. Okay? Now, when we're in breakout momentum, we're usually coming down to that 20 and then climbing, down to that 20 here and climbing. So right now, this is critical here. Are we going to fail at that blue 20 SMA tomorrow, or are we going to climb above it? We're not going to know until towards the end of the day unless we see some momentum higher or lower in the morning. But this is what's really important with strategy, with the strategies we just went over, with the vertical spreads, the puts, or the calls here. Because if we do continue that climb, we could buy back those short legs on our vertical spreads. And instead of making $1,300 on that, well, that Facebook spread, for example, was $1.30 a contract to be worth $2.50. So obviously that's a max net gain of $1.20 or $1,200 for 10 contracts there. But if we buy back that short leg there, then our gains are unlimited as we continue higher, and we can lock in a profit on that short leg. So that's a little bit more advanced, you know. So those of you that are new here, don't get confused with vertical spreads. I'm just going over the real reasons so you could see why we're entering vertical spreads when we do and why we're making those spreads when we do there, because we're taking advantage of certain situations that offer a better opportunity. Because now if you take a look here, if we fail tomorrow, where's our next area of support at on SPY? Well, 320. So if we look here and say, okay, if we fail tomorrow and drop below 335, we could be looking at the 325, 324 put spread. Now let's change this from call to put. Okay, so then we would be buying the 335, selling the 334. I'm sorry, the 324, 325. There we go. Now here's the beauty of this, guys. So take a look at this. So you see, if we bought the 325 strike put and sold the 324, it's going to cost us 14 cents or $14, right, for this trade. Now, what's the max net gain on this trade? And this is where you're going to make some serious money here if you see that failure at that blue 20 SMA. If we fail that tomorrow and we see that red candle like this, if we see that candle tomorrow, this is the type of strategy we're going to do. This is called a vertical put spread. So what we're doing is we're shorting the stock basically at 325, giving someone the right at 324. So our max net gain is the difference again, $1, and our max net gain is at 324 or lower. So our max gain is here and lower. So that's where our max gain is. Right at about here or lower. So at 324 or lower, we're going to make the difference between that. If we're paying 14 cents for it to be worth $1, look at how large of a gain this is. 1, divide that by 0.14. That's a max net gain there of 614%. So that's a 614% gain if we get a red candle tomorrow and we enter into this vertical put spread on SPY that expires on September 18th. Now, why would we do that? Well, if we got a candle that's below support here, of course you're going to be looking for a continued breakdown momentum, because then you're going to start to see that 10-day cross below that 20, and we're going to start that breakdown momentum, and the markets are going to be heading lower. So if you do happen to do that, this type of trade that makes a 614%, that quickly makes up for that retracement here. First off, the first candle below the previous candle's body is a sign to start hedging, you're long. So right here, you see right here, that first area that was below that previous candle's body right here. So here's that body right here, right, on the green candle. That's the hollow body. The first body below that previous candle's body, which obviously is right here. So on this candle right here, that's when we started hedging with our puts. And you saw we were able to buy some puts and keep the account from dropping lower by hedging ourselves properly with those puts. Okay, now what we're doing is we're looking to come down to support right around 335, 333. We're climbing so far. So right now we're getting up to that 20. We failed. We didn't climb above it yet. You could see the wick got all the way up to that blue 20, but the body is well below that 20. So that to me, that's some bearish signal right there for me personally. So if I see that red candle tomorrow that's below that 335, this is the type of trade you make not only as a hedge, but something to grow your account. Because if you're only paying 14 cents for it to be worth $1, that means you could get 10, let's just say you got 20 contracts of this. So 10 contracts are going to cost you $140. 20 contracts are going to cost you $280. So $280 will get you 20 contracts, right? The nice thing about that, those 20 contracts that you just paid $280 for could be worth $2,000 if you get a candle below that 324 on Expo. If it's at 324 or lower on Expo, that's going to turn that $280 into $2,000. That's where you're going to make that 614% return. And that's why it's so important when I say, guys, it's really important to be patient and disciplined here, watching for that break above that blue 20 SMA or a drop below that support area. When we're not doing anything there for a reason, that's why. Because you could get faked out of these positions really quick there, and you can make a monster decision that could destroy your account, that could bring you down 20% really quick. But by utilizing these strategies, if we do break down, we could pick up a quick 614% gain if we come down to that next support area. You know, and that's easy. That's really easy to do. So that's why I like to take advantage of these vertical spreads, because if the market goes against us, we could buy back one of the legs there, the short leg or the long leg, and then we could let the other leg go and add to it as well. That's what we're looking for as far as that goes. Now, covered calls, this is something that's really simple. I'm just going to go over covered calls for a minute here, because this is something a lot of people ask questions of. Now, here's the great thing. Once you start growing your account and you start really making profits, like we had one of our members take a $9,000 account to $100,000, right? Now, here's what you do in situations like that. You wake up after a month of joining us, you're up $90,000. Well, what the heck do you do? And that's one important question that a lot of members have problems and issues with, because they think, oh, wow, if I made $100,000 in 1 month, I could easily turn that into $200,000 next month or $1 million next month, you know? And that way of thinking is really going to screw you up. Number one, because of your contract sizing. If you start making large trades, $50,000 trades, you're really going to come up on the unusual options activity. And then those market makers that got billions of dollars, they see your 100,000, that's their lunch money right there. You know, they're going to say, let me knock them out of their position. They'll short the stock and they'll have the stock drop and they'll collect your premium on your calls there. So it's really important to shift strategies once you start making a good profit. And what I like to teach then is once you start making that money, you start putting like at least 40%. You know, I'm not a financial advisor. I can't tell you guys what to do here. But what I like to do, take 40% of your profit. So let's say, for example, this week you made $10,000, right? Take 4,000 of that, put it in another account. Each week that continues to grow. And now what you could do is use the covered call strategy. And this is a beautiful strategy, because watch what happens here. Let's look at Apple, for example. Apple, for example, let's say you bought 100 shares of Apple, because you need to own at least 100 shares to sell a covered call, right? Because when you looked at the option chain here, you saw this. You saw this. Standard options, 100 shares per contract, right? So that means you need to own at least 100 shares of something to sell a call against it, a covered call. And a covered call, there's absolutely no risk. No risk whatsoever with a covered call, okay? Now, what I want you to understand here is you could, in that other account that you start storing your profits in from actively day and swing trading, that other account now is going to be your longer term account. And what you could be doing in that account here is you could be buying shares of Apple. Let's say you bought 100 shares of Apple at $117. So 117, multiply that by 100, that'll cost you $11,700 for that Apple trade, right? So $11,700, and now you have control over 100 shares of Apple. Now watch the beauty of this. Let's say every month you want to start collecting a premium. Well, now that you started shifting your profits from your active trading account over to your swing trading account that you're going to be doing some covered calls in, this is what you could be doing. You own shares of Apple, right? So now you're going to get paid 3 different ways from owning these shares of Apple. Number one, you're going to make the difference from where you bought the shares at to where the stock goes. Number two, you're picking a stock that pays a good dividend. Apple's got a pretty darn good dividend. So you're going to be getting paid to own the shares, the dividend. You're going to be getting paid the difference from where you bought and where you sold. Now, the third premium you're collecting are these covered calls. So let's take a look at this now. So every single month you could do it weekly and stuff, but I go with the monthliest. So October 16th, let's say you say, okay, I could see Apple getting back up to 130, right? You want to sell the 130 strike call for October 16th Expo, right? The 130 strike here, it's going for $3.02. That means you're going to collect $302. Remember, there's 100 shares per contract. So you have to multiply that 302 here, theoretical value, by 100. It last traded at 306, but theoretical value is telling you what you could get right now for it. So $3.02, multiply that by 100, you're going to collect $302 just about every month just from owning those shares. Now, here's the thing. If Apple gets up to 130, now you make the difference of 117 to 130. So 130 minus 117. So that's 130 minus 117. So that's $13 per contract, right? If you have 100 shares, 100 multiply that by 13, you just made $1,300 on the share price. Plus you collected $302 on selling that covered call. So now you just made $1,602 on an $11,000 trade. You made over a 15% return by owning shares and selling the covered call. And now do you know what? You got a dividend coming too. If you own those shares by the ex-dividend date, you're also going to be paid that premium of that dividend. So now we could go right up here to Apple. And we could look in AAPL. And this will tell us our dividend here. So here's the Apple dividend. The ex-dividend date was August 7th, 2020. The pay date, August 13th, 2020. It's paying you 20 cents a share, 20.5 cents a share. So if you own those 100 shares, right? 100 shares, multiply that by 0.205. That's another $20, $21 just for owning the shares on dividend. And that's something you're going to be collecting on a quarterly basis. And then that $302 you're selling those covered calls from, you could be doing that every single month and selling those covered calls, bringing in additional premium. So that's what's important. When you start growing an account, put money on the side in another account so you could be buying shares of your favorite stocks that are continuing to climb there and ones that are still breaking higher. So you're collecting now on 3 different ways, from that breakout from where you bought the shares at up to where that strike is you're selling, and then also the dividend that you're collecting. So that's a great way to grow that secondary account right there. So now what I want to do, we're coming up at 6 o'clock here. I want to open up for a few minutes, questions and Q&A here in the trade room. So if you guys have any questions, I'd like you to ask in the trade room here, something that pertains to this topic here. The topics that we went over, either the chart setups, calls, puts, covered calls, vertical spreads, anything that we went over today, I'd like you to answer. And then what I'd like you to do is we're going to take a survey after here and see what topics our next class is going to be on, what you guys are interested in. All right, so if you guys could go in the trade room now, let me know. If you guys have any questions, I'd love to go over those questions with you. Ron, general rule of thumb here is the simple moving averages. So Ron asked a great question. He says, how do we know when to get out of the spreads if they go against us? Sometimes it's hard to actually see the profit and loss on it. That's a good question, Ron, because see, now here's a perfect example of something that Ron just brought up. And this is something you have to understand. So when you're doing these spreads here, buy to open, sell to open, and let's just do this one on Qs, for example, here for next week's expo. Okay, so let's do a 270, 750, let's do a 278, 279. Here, we'll do 279, 280. That's really simple. Okay, so this is going to cost 52 cents, 53 cents to be worth $1, right? Now, here's the reason why you see discrepancies on your spreads all the time. It's because, number one, you have the bid and the ask. So the bid is where you buy, or the ask is where you buy, the bid is where you could sell. And you're looking for somewhere in between here. So you could see on the 279, you have a bid of 609 and an ask of 623. That's what? That's a 14-cent spread there. So that means $14 per contract. If you have 10 contracts, that's a $140 swing right there just between the bid and the ask. And that's just on one leg. Now here's the other leg, 557 to 570. That's what, a 13-cent. So if you have 10 contracts, that's $130. So $130, $140, that's now what, a $270 difference there between the bid and the ask of those two contracts. So if you have 10 contracts, that's $270 just right there, and that's just on these closing prices. Sometimes you'll see the spread. A spread is known as, you know, the difference between the bid and the ask. Sometimes you'll see those huge, like $1 wide. So that's why you're seeing sometimes your spread's up $1,000 and next minute it's down $300. It's only because the last traded price and because of the bid and the ask. All you have to be focused on are those strike prices. So when we make a vertical spread and we say, hey, like for example, if we got into the Qs and we bought the 289, 290 vertical call spread right now for 15 cents to be worth $1, that's a pretty significant gain there of about 600%. So we would say, okay, our stop is going to be the first candle below 275. So if you get a candle that's closing below 275, that's when you want to exit out of that trade and protect yourself from that downside. And obviously with that being such a tight stop there from 277 to 275, that's only about $2 difference there compared to what you're looking for here, 289, 290, which is another $12 out. So you're having a tight stop to protect yourself from the downside while still looking for that 600% upside there. And when you're looking for that short-term September 18th, obviously if you get a candle below the previous candle's body, like right here, that's shown further signs of breakdown. And if you do break down, look at how on this candle right here, you're at what, 275 just about. That first candle below the previous candle's body is a sign of retracement back down to support. You retrace for 3 days. Now, even though you retrace for 3 days, how much longer after that breakout is it going to take you to get back up to that 275? And you can see 1, 2, 3 days of breakdown, and then 1, 2, 3, 4 days until you get back up to where you were. So 3 and 4, that's 7 trading days. That's a week and a half there. So a week and a half it took you to retrace and climb higher there. So that's why when you're trading vertical spreads, you have to understand, okay, number one, where are we going? What are we doing? And our calls too. Calls puts anything. You have to understand, you might have 3 days of retracement, but then you might have 6 days of climb to get back up to where you were. So that's why it's important when I say you're looking for those longer term expos like the October expo that you could buy back those short legs on that confirmed bounce off support there. That's what's really important. But that's the difference you're seeing in the prices there. Beth asks, does it matter if you look at 3 month or 6 month? It absolutely doesn't. I don't care if you look at 1 month, 3 month, 6 month, year to date, 1 year, or 3 years. All that means is you could use your mouse. You could zoom in and out. You see, now we're at 1 month. That's all that is. So when you have up here as a daily chart, that means each one of these candles represent 1 day, where it opened, where it closed, and the highs and lows of that day there. And that's what's important there, the opening, closing, the highs and lows. The highs and the lows, these are known as the wick. So these lines here, you're saying, okay, here's where it opened, here's where it closed. It got up to, see that green line here? It got up to 342.50, and it got down to, what is it there? And it got down to, 336.71. So the wick tells us where it got up to, where it got down to, and then the body tells us the opening and closing price. So as long as this is on a daily, each one of these candles represent 1 day. If we change this now to let's say we change this to let's go to a today 1 minute. Now each one of these candles represent 1 minute. If we change that from a 1 minute to a 15 minute, now each one of these candles represent 15 minutes. So you can see right here, for example, this says 12:30 down below. Next candle is 12:45. Next candle is 1300, 13:15, 13:30. So each one of these candles now represent 15 minutes. If you're if you're a little bit more stressed out when you're trading, you're a little bit emotional trader, use the 5-minute chart instead of the 1 minute. I like using the 1 minute because I'm a professional trader. I've been doing this for a long time. I know exactly what I need to look for. But if you find yourself like emotional, that 5 minutes is going to give you a little bit more breather room as far as the trade plan works. And you can see it still follows that trade plan perfectly. So instead of looking at it today 1 minute and getting a lot of information every single minute there, like that's a lot of information in 1 minute. When we zoom in though, we could see it pretty clearly. But if you find yourself being a little bit emotional, change it from a 1 minute to a 5-minute chart. You're only doing 1 minute and 5 minute if you're day trading. If you're swing trading, all you're cared about is that daily chart. Daily chart is all that matters for swing trade. If you have something that expires next week, all you care about is where that stock ends today. So again, 3-month daily, that's all you really need there. If you're day trading, then that's when you're clicking on it today, and either you're using the 1 minute, 5 minute, 10 minute, 15 minute, depending on your style of day trading. Ron, so if you're in a vertical spread, like let's say, for example, you made a trade on Qs, you made a bullish trade, you got something here, your stop is going to be that 270. If you're pulling back and you're dropping below that 50 SMA here, in this example, that's going to be your stop. Your support, your next level of support is going to be your stop on any type of shorter term trade. For longer term trades, it depends how long you're out. If you're out 6 months, then obviously you're going to look at a 6-month daily and see where your support areas are. You're not worried about short term support. So here, 250, 260-ish, 270. So 270 would be my S1. I'd say 260 is going to be my S2. So stop 1, stop 2 if you want to position out of it, or you support 1, support 2. That's what's really important there with trading is managing your trades. Managing your trades, that's why we go over stops, targets, support, and resistance areas on every single trade we make. If I say, hey guys, this trade has a stop at 270, a first candle below that red 50 SMA, now you know exactly what to look for. If we got a bullish trade here and we entered into a vertical call spread on these Qs here and we start to head higher, well, then we're going to be increasing our stop each day as we go along there, because we want to protect our profits. So, if we just got into this Q spread today for next week's Expo and I say, hey guys, 270 is going to be our stop, first candle below that red 50 SMA, then we get a candle closing below 270, we're out of that trade. Now, if we continue to climb there, then we might add to that and take that into a ratio spread, which is another topic for another day. A paycheck trade will not make you money if it's below both strikes at expiration date. But here's the thing, 50% max stop loss on any paycheck trade. Paycheck trades we do on a weekly basis. So every week we're looking for paycheck trades. And when we do find that good setup for that paycheck trade, that's when we're going to initiate a paycheck trade. And every paycheck trade is going to have a max 50% stop loss there. But usually we're not seeing losses on our paycheck trades. Alrighty, guys, that's going to do it. This class will be recorded, and we will have this on the website later. So I hope you guys had a great night, and I will see you guys tomorrow morning. All right, take care, guys. Have a great night, and God bless. Stay safe out there.